This is Brian Trippe, and you're listening to episode 16 of the REIA Masterclass podcast. What's going on, everybody? It's Brian Trippe right here in Birmingham, Alabama. I'm so glad you decided to join us today. We've got a great guest in the studio in my office that we'll get to in just a second. I just want to make sure that you guys are aware of everything that we got going on. Our website is finally up and launched, alareia.com. It's ALAREIA, so make sure you go to that. We've got a lot of really cool events coming up. Our monthly meetings, obviously, they're the second Thursday of every month, so definitely check those out. The next one is going to be in May, so you can get on our meetup page. You can search REIA on meetup.com, or you can just go to alareia.com. You can go to our Facebook page as well. We're also in the Huntsville market. So we've just had a couple of meetings up in Huntsville, and we're going to launch something really big. We're going to have some really cool, exciting things to announce here very soon up in Huntsville. So definitely make sure you are keeping track of everything that we're doing. Obviously, you're listening to the podcast, or you wouldn't even be here, so you know about that. But our daily REIA show, check that out on our YouTube page. Check it out on our Facebook page, facebook.com/alareia. And if you want a copy of my free book, just shoot me an email. I'm going to send it out to you, info@alareia.com, info@alareia.com. Well, without further ado, I want to get into our guest today, who's Aaron Chapman from Security National Mortgage Company out of Arizona. Aaron actually came and spoke to our REIA a couple of months ago, back in March, and just knocked it out of the park, gave us some great information. If you want to look up that keynote speech, it's on YouTube, so you can just search Aaron Chapman, REIA, and it'll pop right up. But I want to really just sit here and talk to Aaron for a minute. How's it going today?
Hey, what's happening, Brian? How are you?
I'm great. I've got so many questions I want to ask you. Our audience is really, really hungry to know about really just loans. I get a lot of people approaching me about how they can acquire real estate at kind of a cheaper price instead of paying cash for it, maybe not even paying 20%. There are a lot of different things that you do. Can you just kind of tell us a little bit about yourself and a little bit about what you guys do?
Definitely. Again, Aaron Chapman, as you had indicated, with Security National Mortgage Company. I've been in this space since 1997. And it started out being involved in the mortgage broker world, and then it evolved once 2003 hit, when real estate investors started coming into the Phoenix market. That I found that I identified with the real estate investor really well. Mm-hmm. I understood the nuts and bolts, what they're trying to accomplish, and that was where I focused my energy at that point, was helping those individuals build their business around the investment real estate. Well, we all will know what happened later on. We all know what went on in the late 2000s and where things started to come to pieces. After things had settled, the dust had cleared, and we were able to see what was available at that point, real estate investors started making their way back into Arizona. And at that point is for a very heavy cash flow environment. And we started working with those real estate investors and started aligning myself with the people bringing those individuals into the opportunities within the Phoenix market. Well, that Phoenix market only lasted so long. And at that point, then we needed to go elsewhere. And that's when I started expanding out, getting more licenses, expanding myself into various markets, and eventually found myself into the Alabama market a few years later. Been working in this market for several years and enjoy it. I mean, the people are amazing. I love coming to visit because the landscape is way different than Arizona,
yeah.
Right? I spent a lot of time in the mountains in Arizona, but it's a whole different feel when you start coming into this side of the country.
For sure. Let me interrupt you for just a second, because I always want to. This is a Birmingham-based podcast, and I really want to touch on Alabama. But how did you even get? I mean, you just said you had to branch out to other places to start writing more loans and doing more business. Why Birmingham, and how did you get to Birmingham? I would think that you would want to go to hotter markets, maybe or tell us about Birmingham. Is Birmingham a hot market?
It is actually one of the greatest cash-flowing markets we see out there. That's the reports I'm getting back from the people I work with. Mm-hmm. And the people I'm working with, of course, is the end user, the real estate investor.
Right.
How I got to the Birmingham market was a demand from the real estate investor. They're going into each market that makes sense. They're not just going out there and buying houses indiscriminately. There's a lot of research that goes into this. They're working with individuals in various markets that helps them understand what can be accomplished there. And Birmingham, through some research and local people here that understood the market, helped people that were coming from other markets, such as like California. They're coming from the Northwest, people coming from the East Coast. Mm-hmm. They start finding that these markets made sense. When you think about where they're coming from, the cost to acquire real estate there definitely does not justify what you're going to get in the form of a return. You come into a place like Alabama, it makes sense. So Alabama mirrors a lot of other markets as far as the ability to acquire, but again, get the cash flow, because it's mainly a wage-based economy from what I can tell. So because of that, you get to a point where they started determining that this was one of the markets to come to. So I just followed them. It wasn't me purposely finding Alabama.
Right.
I was asked to come to Alabama.
Right.
It was the people buying the real estate says, we need you to get a license in Alabama. So I got a license in Alabama. It just made sense.
So it kind of begs the question for the people that just don't know the business, and myself included, why wouldn't someone from Alabama, well, I guess you're working with people more on a national stage, but say an investor from Alabama that lives in Alabama that's purchasing real estate in Alabama as cash flow real estate, why would they go to a guy who's writing loans in Arizona?
It's a solid question. I've actually had that a lot, and say, how is it you're out here and you live thousands of miles away? Well, it's because in our environment, the real estate lender, if you will, most of the time it's a very transactional relationship. I'm going to get you a loan, you're going to close, we're going to end the relationship. If you need me later on, just call me. Right. Well, it takes a lot of energy, a lot of time, a lot of strategy to build a business around helping people build their business. Right. So how I deal with the real estate investor is, and we've talked about this in the past, we look at them as kind of like the CEO of their real estate investment firm. Right. And so since they're building a business around that and they're their own decision maker, but a CFO can't sit at every chair at the board table. They need to have a chief operations officer. They need to have a chief financial officer. They have to have people that handle the legal piece of it. All these pieces, and they can't do it all. Because those real estate investors, the way they became real estate investors is they had to make the income and build the assets to invest in that somewhere. So they had to have a job somewhere to build that up. So we always tell people, stick with what you know. Stick with what got you there, and let other people do it for you. So now as the CEO, they pick your chief operations officer, which I'd argue in many cases is Mr. Brian Trippe, and who is operating that business for them because of what your knowledge is. And so you're like their regional operations manager in Alabama. Then when they're looking for somebody to help on the finance piece, that's where I'm a little bit different. That's why I'm making it into 23 states. That's why I carry 23 licenses, because these people are like, I can talk to all these other lenders, but they don't understand what I'm trying to do. Right. It's a very transactional relationship where what I structure for them is, let me help you build your business. Let me take your financial profile. Let me take your income and your assets, and let's stack that in a way to make you successful in the acquisition of real estate. Then I'm going to purposely hang my licenses with a firm that understands that knows how to generate, how to use the lending capability they have to make it advantageous for the investor to continue to acquire property. Instead of hindering them, we're going to assist them. And so because of that, we're able to generate business. And my business is really building business. I generate revenue by closing loans. Now, individuals can go anywhere to get the loans. I understand that. If you got a local relationship, give it a shot. Right. But I argue many times, just because of what comes back, that the individuals you're working with on a local basis, or really many in a national basis, they don't understand the real estate investor. It's a very complicated process. And it's much easier just to, hey, somebody wants to buy a house, do the loan and walk away. We are there for the long term. Right. We are not going anywhere. In fact, you're stuck with us once you start working with us, because we need to help you drive that, and we are driven by that, so we don't go away real easy. Yeah. So there are a lot of different directions we could go. I definitely want to try to hit on this as much as I can. So if I want some practical steps. I'm the real estate investor. Maybe I'm a new investor, and I want to get started, and maybe I don't really know where to get the real estate. I don't really know who. What kind of advice can you give to someone who's brand new, maybe has a little bit of money to actually get started? Go to a turnkey company? What's kind of your advice? Well, the first thing would be to partner yourself with somebody that can help you figure out what your capabilities are. Which could be who? Which would be on the lending side. Okay. Because they're the ones going to tell you what your capability is. Okay. So I would hope that it's somebody with myself and my team. I would hope that is the decision. Right. But it's a matter of becoming comfortable with who you're working with. Let us take the time to analyze your profile. Let us look at your finances. Look at what you have your capability doing. Then we can structure what can you do. Once you know what you can do, then it's a matter of finding that individual you're comfortable with. It's the Brian Trippes of the world that are your operations person on the ground that understands that particular market, that can say, okay, now that you guys have determined you can buy, let's say it's 8 properties with the cash, with the amount of income you have versus the amount of assets you have. Now we need to go find those properties that fit that profile.
Right.
And then we can take that, and is there a capability within those 8 properties to use those to leverage to an extent to get 10 properties? And is there other strategies we can use to actually wipe those properties out within a short period of time to be able to acquire more? There's so many different ways we can go about there, but the very first step is to find somebody that can help you analyze what you have and tell you what your capability is. And let's say you don't have the capability right now. Let's say you're just short. You don't know that yet. But if you have somebody that can tell you where you're at and then give you a game plan on how to move forward, you know how much time you have until you get there. So you can target it. You can plan your business out. The worst thing a person can possibly do is sit there and just wonder. Yeah. So it's time to, I would say the initial step is it's time to leave the comfortable space of thinking and go to the actually uncomfortable space of acting, in which is giving somebody a call, in my world, to walk you through it.
Yeah, for sure. So do you recommend a turnkey company?
I recommend, there is some turnkey companies I work with. I mean, when you're talking about the Alabama situation, the Alabama market, I mean, say, listen to where you what you throw at the very end of this particular podcast, and make that call to Brian and say, let's get rocking and rolling.
Yeah. So call. You would say, if the practical first steps, let's see what your capabilities are.
Correct.
Let's see what you can acquire, what you can do, and then let's try to identify a property that fits your
exactly. Yeah, it's that, and also if you're talking to various different turnkey companies, finding somebody you mesh with, right? Just because they may have the property, maybe the individuals that you're dealing with there don't understand what you're trying to accomplish. You're trying to hire, again, a chief operations officer that can get behind what you're doing, that is going to walk with you down this path. This can be a very treacherous path if you're going down it wrong. I do rescue on the side for the sheriff's office.
Yeah, tell us about
I'm in the I'm in that space of technical rescue, which is your high angle stuff, cliffs and caves and that kind of thing, and then also air rescue, where we have to get flown in, rappel out of a helicopter, hook the person, and pull them out. When the person's going down a trail, it's very treacherous for the first time. It's much easier when you've got somebody who's been down that trail before, who can help guide you through it.
Yeah,
right. But if you're going to try and go out on your own, there's a good chance you're going to need me to come in later to get you out. So it's better to be able to run that thing with competent people that have been down that before, that can guide you. That's where we fit in. Yeah. That's where the finance piece, as far as my team is concerned, the turnkey guy that can really act as that chief operations officer or that local regional operations manager, plays a key role to walk you down that path and tell you where, hey, that's a rattlesnake den there, or you got a pretty rocky spot there. If you step here, it's kind of soft. You'll end up in some cholla, and cholla is not a fun cactus to get touched by. So we know these things. We guide you, because what I really have found with most turnkey people that are really good, honest folks, and the people that work with us, we work together in a way because we are so concerned about the individual's business, the individual investor's business, that we don't have to worry about ours. It's take care of itself.
Yeah. So I guess anybody that's listening to this podcast is obviously interested in real estate, but I would even ask you the question, why real estate? Why real estate over a stock? Why real estate over any other type of investment?
Well, there's a lot of different metrics people use when they're trying to analyze different data. So there's all kinds of different things that people are going to spout off as a way to analyze something. And when you're talking about the real estate world, we've talked before, people like to use cap rate. They like to use cash on cash return. They look at rent to value ratios, all these things. And I like to really simplify it a lot. And some may argue I simplify it too much. But let's talk $100,000 transaction. And let's talk the 30 years, because I always recommend a 30-year fixed transaction. So if you're buying a $100,000 piece of real estate, and we can finance that for you at 80% loan to value, so you're putting 20% down. What number is that? How much are you putting down when you're putting 20% down on a $100,000 purchase?
You're putting $20,000 down.
$20,000, right. So I also tell them budget for $5,000, that you're going to put $5,000 into the transaction at closing to cover the cost of appraisal, the cost of your inspections, the title company, the lender, the taxes, the insurance, all these things. And so $5,000 is going to come out of your pocket. How much money are you spending at closing?
Well, I've heard this spiel twice already before, so I know your answer. But I'm still, and let's debate this. Let's talk about this right here on the podcast.
Right on.
$25,000 is most people's answer.
Correct.
And your answer is?
My answer is $5,000.
Okay, explain.
Now, the reason I explain it as $5,000 is because the $20,000 is still yours. You just moved it from a liquid account into a non-liquid
Right.
investment. In reality, there's still $20,000 sitting there that's yours. And I know that some people can point different thought processes, but it's not spent. You can still liquidate it through some steps, but it's still sitting there. And working in the right environment, depending upon how you're getting the property and where its valuation is at that point, there may even be more there. But let's just say it's $20,000. Mm-hmm. Well, that is going to grow on its own because somebody's living in the real estate paying down the note. And by it being paid down, it's going to go from a $20,000 balance to $100,000 over a 30-year window.
Right.
Right. So if you divide that amount up, that $80,000 over 30 years, that 360 months, the annual amount that's going back on top of the $20,000 when averaged out over 30 years is 13.33%. So you're seeing that kind of growth. That is not defined in any metric out there. So now let's flip to the other side. You spent $5,000. That's why my argument is that's what you're spending. Because when I'm talking about something that's being spent, it's gone. You'll never see it again.
Right,
you do not have access to that money again unless you take legal steps. But let's not get into that.
Right.
So $5,000 is spent, vaporized. But the average I'm seeing out there in a $100,000 purchase, and more kind of even on the lower end, is about $250 a month in cash flow is what I'm seeing many of my investors coming back with. After they pay for the note, they pay the taxes, they pay the insurance, they pay the property management fees, they're looking at about $250 coming back to them. Well, that $250 is going to return your $5,000 in 20 months. So now after 20 months, you got your $5,000 back. You're now playing with no money in this deal.
Right.
You're playing with the house's money. So now over the remaining 340 months of this scenario, that $250 becomes $84,000. I'm pretty sure it's 84. I'm going off of memory here. I don't have my calculator. So let's just say it's $84,000 that you got out of that. So now you have your 20 turned into 80. Or excuse me, 20 turned into 100, but you keep your 20, so it really just made 80. Mm-hmm. Your $250 a month after getting your $5,000 is 84. So that's $164,000. That $164,000 you received you still got your 20 and you got your 5 back. That's before appreciation. That's before rent increases. And that's before the tax benefits associated with it,
Correct.
right? So a lot of people will say their next argument is, but wait a minute, I may have some vacancy and I may have some maintenance. Agreed. So I have polled a lot of turnkey guys. A lot of people are fixing up these properties, especially the ones that do a very good job. And I asked, would it be reasonable to think that a person can maintain a property and in many of these markets deal with vacancy with $40,000 over a 30-year window? Some have said that's a very aggressive number, saying that's way overestimating. Right. But I say I prefer to overestimate. So let's say it's $40,000 that it costs you to maintain it and deal with vacancy over that 30-year window. That's still $124,000 before appreciation, before tax benefits, and before rent raises. And you got all your money back out of the deal.
Right. So and we already talked about this.
Yes.
Just letting everybody know. But my argument back, everything you're saying is 100% legitimate and 100% correct if you hold it for 30 years.
Correct.
And and I know most people aren't going to hold something for 30 years. They're just not going to do it.
So what time frame would we say would be a reasonable amount of time frame for the person to dump it?
I don't know the answer to that question. But let's say it's 10 years.
Okay.
And we all know that the interest is front loaded. And so you're paying mostly interest. And that's kind of my argument back, that where you're right, if you're holding it for 30 years, and everybody goes into a transaction wanting to hold it for 30 years. They envision themselves holding it for 30 years.
Yeah, everybody envisions that. That's why we get into a lot of discussion about rates and other things, because I'm in this for the long haul. And I get that. And that's why that's where this came about, was because people's in it for the long haul.
Right. Very good.
Let's talk 10 years then. So
okay.
It is. Interest is very front loaded, especially in a 30-year fixed environment.
Right.
So since it's front-loaded, let's cut this thing down. Now, I don't have an amortization calculator in front of me. I don't have any of that stuff where I can take a look at it. But let's just say it's knocked down to where you're only getting, instead of getting that full $80,000, you're only going to get 20%. Let's say you're going to get 20% of that.
Okay.
You still have your $20,000, right?
Right.
You still your $20,000 is not gone.
As long as it hasn't depreciated, as long as the bottom hadn't fallen out of the market.
True. As long as your $100,000 property didn't become worth $15,000. Okay.
Maybe not that far, but
yeah, I mean, but you're still, even if it's worth $25,000, you can still sell the property and get your $20,000 back out of it, right?
But you got a loan to pay off.
True. So, I mean, it's one of these situations here where there is some catastrophic consideration here.
Right.
We do have to think about that. But let's take that metric and flip it back around then.
Right.
So, if you're one that likes to use cap rate and cash on cash return and all that kind of thing, right? What does that do to that?
Oh yeah, blows it up.
It still blows it all up.
Right.
There's inherent risk with everything, right? So, if a person is going to take their money and put it to work somewhere, you have the opportunity to keep going into the stock market. A person still has the opportunity to go into other markets and other instruments. Where do we sit in those type of environments if things get that catastrophic in the real estate world, especially the turnkey real estate world? I mean, let's touch on one other thing here.
Okay.
Turnkey real estate, right? These markets that are the great turnkey markets like Alabama, one of the highest cash flowing markets that's out there, that at least what everybody keeps telling me and what I keep seeing in the numbers that are hitting my desk.
Right.
We're talking about very wage-based economies, right? These are economies that don't move with trends. So
no, that's true.
When you're talking about economies that don't move with trends, you have to consider what's driving it. So let's consider these wage-based economies. You remember Robert Reich? You remember that Bill Clinton's labor secretary in his first administration?
Yep, I've watched his documentaries.
Okay,
yep.
So the recent documentary he did was Inequality for All. Remember that?
Yep, I watched
What
that.
year did he say in that was the highest median income for the average worker during, of course, adjusted for inflation? Do you remember what year?
Was it 70s?
1978.
Yeah.
What amount was that? Do you remember the dollar amount?
It's very similar to what it is today. Is that right?
He said $48,000.
Okay.
If I remember correctly, it's 48 and change.
Okay.
Somewhere right around there. Somebody can watch that and call me out on it someday, but I know it was in the high 40s.
Close.
But he did that. He did that conversation, or he did that documentary in 2011. So then he said in 2010, what was the median income in 2010 adjusted for inflation?
It was about the same, wasn't it?
32,000.
It was lower.
33,000, somewhere in there. It went lower. So wages were going down.
Yeah.
Cost of living was going up.
Right.
What do you say the average 1%er was making at that time? He was saying somewhere right around 303,078. He said 1.1 million in 2010, again adjusted for inflation.
Right.
What the dollar was doing for people at that point. So why is that applicable? Because if a person is making in 2010, I don't know exactly what the number is today, $33,000 a year based upon where we are in our inflationary environment and the cost of living, does that person have enough money to put a down payment and go through the expense of fixing up one of these properties to own it and buy it?
Probably not.
Probably not. And if they're living in a economy where it costs so much just to exist, there's a good chance their credit rating is not allowing them to be in that space either. Because we're really kind of tight on the credit right now. When it comes to credit, how a person's credit score relates to being able to get financing. So since we live in that kind of environment, we're in a place where that is the optimal environment for a renter because it's a wage-based economy. In fact, even Fannie Mae has recognized that from what information has been downloaded to me recently, that
Ah,
home ownership is down. But home sales is still up because real estate investors are in that space buying it.
Interesting.
So we know that we have a lot of renters out there still. So a wage-based economy is a great place to be a renter. A landlord to have renters, right? So that would be another reason why I'm very optimistic about the real estate economy, especially in this particular type of environment, the cash flow environment,
right,
versus every other potential investment vehicle that's out there. Now, are we subject to catastrophe? Hell yeah, we're subject to it. But there's also other metrics to benefit us here. So let's say you do experience that catastrophe, right, that you just brought up, and now all of a sudden you can't sell it enough to pay off the note because things did go upside down.
Right.
We've experienced it. We've seen it. We are now not in a place where we can plead ignorance because we've lived in that world. So does that mean you hang on to it long and keep getting your cash flow? Because in that particular world, there's probably still a good chance people still need to have a roof over their head. They still need to keep the rain off.
No question.
And so a person's still going to be renting and still be cash flowing. So the argument, I believe, still stands in the sense that somebody is paying off the note because just because you're not in a space to unload it doesn't mean you unload it.
No, you're 100% right.
And if you drew out a map that says, I want to unload this in 10 years, but in 10 years it's not going to let you, you change your map.
True. And that's why I play devil's advocate with Aaron. He's a sharp guy, and I know he can fight off anything I throw his way. I really want to touch on something that I know you don't talk a lot about, at least since I've been around you, but I feel like a lot of people here in Birmingham, a few that I know of that are using you, they really like that method where they buy it for cash, and then they fix it up, they put a tenant in there, and then they refinance with you and try to pull all their cash back out. and you do all Fannie Mae loans, so you're all, it's all just kind of standard stuff that you could really get anywhere, but you are an investor savvy and investor friendly mortgage guy. Is this a strategy that you recommend to people above and beyond the normal 20% stuff?
I love the strategy.
Okay.
And I think that you're right. We don't talk about it enough. And it does need to be discussed a lot more, because that has made people small fortunes in my space. And like you talked about, I'm a Fannie Mae lender. I'm your most unconventional conventional lender you'll ever meet in your life. And the thing about it is, the conventional lender is usually focusing on your people are going to be occupying a home to live in. And people, it's amazing how many in the real estate investor world don't understand that you can get conventional loans for this. Mm-hmm. I'm still amazed at how many people thought that they still had to do conventional because it's an investor loan.
Right.
So what you're talking about is that's commonly known as deferred financing or delayed financing, meaning that the individual would have financed it, but they were in a situation where they found it best to pay cash. So when you're paying cash for a home, let's say it's you buy the home for $60,000, right? You put up your cash, you buy it for $60,000, and you got a deal on it because you're willing to pay cash,
right?
And you have a renter in it, it's fixed up, ready to rock and roll. You can clean it up, but the houses will easily appraise for $100,000. Now, this is a scenario that has happened. It's happened more than once. It appraises for $100,000. I have the capability to finance starting the day after you close, the day after you pay cash. We can start the loan at that point because you have ownership on it. Mm-hmm. I can start the day of you take ownership. When it appraises out at $100,000, I am limited by two things at that point. I'm limited by 75% of the value, which is $75,000, but the loan amount cannot exceed what you paid for it. We're not going to give you cash above what you paid for it, but we will give you up to the amount that you paid. You get 100% of that back out in that particular scenario.
As long as it's under 75% LTV.
As long as it's under 75% loan to value. And so there has been many of the investors I've worked with in the past, when they purchased in the right environment and they bought right, that they were, in fact, we even have one that we've worked with together. He did this 4 times in a row, that he was able to pull out 100% of that capital, then redeploy it into another property.
So you're recycling the same money over and over how many times?
He recycled the same $60,000 4 times. Just the last one, actually 5 times. On that 5th one, we were off by 5% on the loan to value, so he left $4,000 in the deal. Not a big deal. He bought 5 properties for $4,000
out of his pocket.
Out of his pocket. He is now one of the greatest recyclers that have ever existed on this planet. Just some people don't understand how well he recycled paper. That was one of the best recycling of paper opportunities I've ever seen. You never see a person make that kind of money off recycled paper.
So go back, if you're listening to this podcast, go back about 4 or 5 minutes and go replay the last 4 or 5 minutes 3 or 4 times and do this strategy right now while you still can. Because things could change, right?
Yeah, and that opportunity has been thinning out. We used to see that when they first came out with that option. Man, it was big. We were doing that a lot. But now a person has to really, really drill down the markets, get with somebody really good at what they do to help them find those properties. They'll pull that off. Mm-hmm. Now, one thing that we have to touch on, though, is it cannot include. There are many that say, "Well, I'm going to do this. I'm going to buy this property for $40,000. I'll put $20,000 into it because then it'll be worth $100 if I fix it up." And then I can do that 75% loan to value thing. I'll get my $60,000 back out because I spent 20 on the house, and then 40 on the house and 20 on the rehab. It doesn't work that way. I'm still limited by what you paid for it.
Gotcha.
That's where a turnkey provider really plays a big, big part, in the sense that if it's a turnkey guy, many times they're doing the fix-up already. They're going to have that $20,000 in fix-up in there. They're going to sell it to you for $60,000.
Gotcha.
That's where they play a massive part in this, because I can't give you money on what you spent to fix the house. I can only get you to the point of what you paid for it. Now, if you have the capability to wait for 6 months,
okay, that's what I was going to ask you.
By that time, when I reach 6 months, then it's just based on 75% of the value. What you paid for is not a factor anymore.
So it would need to season for 6 months in that scenario.
In that scenario, we season for 6 months. Or if you've got a great turnkey group that you're working with that'll do the work for you, acquire the property, do the work, sell it to you for the $60,000, then you're in good shape.
Explain to us the difference between a Fannie Mae loan and like a portfolio loan.
So to really understand the whole Fannie Mae thing, Fannie Mae is an institution that backs the money.
Okay.
It's not their money. It's not the bank's money. This is Wall Street investment capital. This is not government money. This is pension funds. And I'll tell everybody on this podcast, go and watch The Big Short. Watch it 2 or 3 times. Seriously, if you haven't seen it, you need to watch it, and then you've seen it once, watch it 2 more times, and then call me. You got homework. We'll discuss it, why it's so applicable, because there's a lot of information there. And you'll notice in the movie as it starts that it is an individual discovered you can take mortgages and you can lump them all together. You can get pension funds to fund it. So this is people's retirement that are funding these deals, right? So what you have is an institution as big as Fannie Mae that's backed by the government that guarantees it. It says they wrote the guidelines. They said if you follow these guidelines that we have created, we will back you up if things go sideways. If you lose money, we'll reimburse you for that. It's like buying an insurance policy, if you will. But they get to get a piece out of the deal, right? If they're going to securitize or they're going to protect it, they're going to make some money off of it. That's how they exist, right? They're a pass-through for that same money. So when that money filters its way from the pensionee, the person who's retired, and their money's being worked out there and put to work, everybody in the middle is touching a little piece of it. And if you're doing it on a big enough scale, everybody's making very good money.
Right. So the difference between that Fannie Mae and portfolio stuff, you guys don't do portfolio stuff.
We do portfolio stuff. Portfolio stuff, yeah. And you asked that question, I got really sucked into the Fannie Mae discussion. Portfolio is more, that would be a bank's money. That's where a bank is saying we have so much on deposit or we have a certain amount of money on hand. We're going to deploy this. But they're not going to send it out there in those particular files because they're not guaranteed by Fannie. This is their own rules. They get to make up their own rules at that point.
Right.
But the rules have to follow laws. They can't just get indiscriminate and start being predatory. They have to be in an environment where they're still being honest, solid with their money, but they're going to be paid based upon their the risk associated with deploying those funds. So the portfolio funds that we have the capability to do is going to be a higher interest rate. You're going to be a lower debt loan to value. So what I have available to me right now is a 65% loan to value, and it's going to be interest rates in the 7s or in the 8s, depending upon what your needs are.
So what would be the advantage of someone using a loan like that?
Well, let's see, credit scenario, right? I can get 600 credit score.
For an investment property?
For an investment property. And it's only for investment properties. We won't do that for owner-occupied. There's a whole other set of rules for owner-occupied that we can't tread on. But for an investment property, we do it's 65% loan to value, so you're putting 35% down. But in certain environments like Birmingham, in this area around here, 35% is not a big amount of money.
Right.
And your cash flows are still extremely strong, even when the interest rate's 2% higher, because your loan to value is lower, so the amount that you're financing is lower, and your cash flow is still significant. It's still growing at a significant rate. Now, that's a 30-year fixed. That's a 30-year amortization. It's not a fixed, and it's a 5-year balloon.
Right.
So it's due and payable in 5 years.
Will you extend it?
There has been occasions where we have extended that.
Or likely not.
No, I mean, there's so far at this point, every time that has been requested to reach that 5 years, it's been extended for another 5. That's if the person's in good standing. If they're looking back on the history and that person has not been good about their payments, why would they extend?
Right.
This is a give and take relationship.
For sure. So as we're wrapping up, this is kind of the final question. I really want to take a second and talk about where we are in the market. What you obviously, you've got your finger on that pulse pretty good because you're writing loans every day, multiple loans every day. Just kind of give us where we stand and where you think we're headed real estate wise.
Well, let me touch on one thing. You mentioned that the word loans keeps coming up, right? Instead of looking at this as a loan, and people are looking at, when you talk loan, you're talking debt. The real estate investor is evolving from debt to this is really a partnership. You're taking on a business partner in the form of a bank or really a pension fund that's going to put up 80% of the capital for your business, yet doesn't want 80% of the ownership of your business.
Yeah.
They only want right now, interest rate wise, you're probably looking at about 5 to 5.25% of that 80% in 12 installments every year, and they leave you alone. You own the business and all the profits, and when it's most profitable at its most profitable point and it's paid down, they're gone. They're out. Your partner's out of it, right? So look at that. You're actually taking a business strategy on the banker's world and applying it in this other world, and you're taking advantage of it in a big way. You'll never find a business partner willing to give you 80% and take a little tiny piece. So just think about that as you're considering the financing piece of it. So when we're talking, you were asking about the market.
Right. Well, hold on. I just want to add to that real quick because what you just said is vital. You've got to, debt, there's kind of two types of debt. There really and truly is good debt and there's bad debt. The good debt is debt that someone else is paying for. And if you've ever read Rich Dad, Poor Dad, that's directly where I got that from. That's where most people get that from. And if you haven't read that book, Go get. Actually, I got like 20 free copies in my office. Just come to my office. I'll give you a free copy. It's a great book, and you really and truly need to understand that there is such thing as good debt. The bad debt is out there. You're out there running up consumer credit cards and stuff. But when someone's paying your debt for you, it's still debt, but someone's paying that debt for you. That's the good debt.
You've taken on the obligation to make sure that it gets
Correct.
paid. You have to ensure it gets paid back. That's
Correct.
it. You're
Correct.
an overseer. You have the oversight on that to ensure it gets taken care of, and you're going to guarantee that it gets taken care of. But for ultimately, that is you're no longer spending money and going to debt. You're moving money from liquid account to non-liquid growing asset, and then you're taking on a business partner who has created an exit strategy for themselves to take a small piece and leave.
Yep.
It's one of the most amazing pieces of it, and people for some reason don't. It's hard for them to view it because we've been so ingrained to think of this as debt.
Yeah, it's brilliant. I mean, it really is brilliant. If you're not doing it, you need to do everything you can to. If you don't have the good credit, if you don't have the money, save up the money, repair your credit. You got to get in the game.
You got to remember, as a real estate investor, you're no longer a consumer. You are now a business owner that is using the consumer-capable instruments out there to benefit you. And we need to get together and show you how you're not a consumer anymore. Consumers will think they're spending money and they're going into debt. That's not the case any longer.
Yeah. So the market.
Yes, sir.
Where do you think we're headed? Where are we now? Where do you think we're headed in the next 2, 3, 5 years?
It is a very, very dang good question, and I wished I could say I knew because I have no clue. Everything. Let's go backwards back to October. Everybody during the time of just pre-election and where things were headed, and the speculation of all the most intelligent people on the planet were saying that if we get Hillary Clinton in as our president, the market would actually probably go up just a little bit, and things would stay the same, and interest rates may see a little bit of an increase, but if things get flipped over on their side and we get Donald Trump as our president, then the stock market's going to crash and the real estate, the rates for our loans would drop through the floor, right? Mm-hmm. So you're watching the election. I remember sitting there watching all the polls reporting, and the stock market is just going to hell as it's reporting. We're down nearly 1,000 points as the polls are reporting. And then the finalization comes out, Donald Trump is now the president-elect. And it didn't take long for all of a sudden the stock market made it back all the way, gained all that 900 points back in overnight trades and the futures opened up, or basically the futures are showing that we're going to be starting at square one, and it spiked the next morning, and it's continued to. Right? So I'm looking at the Wall Street Journal today, and we're saying that it's seeing that there's a lot of fear that the steam is going to run out of this thing. When? Who knows? Yeah. Right? I've heard arguments for all sides. Interest rates have to go up. They're going to jump several points. I'm also seeing arguments that if the stock market goes the direction it's going to go, we may see interest rates at an all-time low again. So I've heard both arguments. And at this point, I'm in that situation here where the only thing I can possibly do about that is to sit down and really deeply consult with every person who's really wanting to get into this space and say, let's talk about your cash flow. Let's talk about how that's going to affect you, because it could be 4% next year. It could be 6% next year. We need to run those numbers and say, if your business is affected by a massive adjustment in interest rate between now and the goal of when you stop investing, whether it's 2 years, 3 years, 5 years, how is that going to impact it? Let's adjust it. Let's make adjustments for that, because if it's impacting the interest rate, it's going to impact rents too. So don't get so concerned about where the rates are going to be, because what you're able to pull in on a monthly basis in the form of cash is what's going to generate your business and how it's going to react to that. Yeah. So interest rate really in a way is kind of, it does work to your benefit in the sense, one, somebody else is paying it. Two, you get to write it off as if you paid it. Yeah. In that type of environment, we never touched on what that does. In reality, it's too long of a conversation to try and touch on what that does. It offsets so much of that, you could actually be in a better position with a slightly higher rate, depending upon the full strategy we're working with. Yeah. So I would just really tell people, let's not get too darn concerned about that. Let's more focus on how do we build it regardless of what's going on in the market, to ensure that – and you're not touching it today anyway, so who cares about really the cash flow? You're putting it back into it. That's right. We'll talk about a couple strategies like a debt snowball. We'll get on the phone. We'll talk about that and how to actually attack these things to set up for 30 years from now. Who cares? Exactly. Nobody cares 30 years from now when you've got when you own these assets and they're taking care of you. No question. So how can people get a hold of you, Aaron? So a couple ways. One, you can go to my website, which is aaronbchapman.com. You got to have the B in there. Otherwise, you're going to get baseball stats of somebody in high school. So aaronbchapman.com. least that was the last time I checked.
B as in boy.
B as in boy.
Okay.
But that's not my middle name.
Boy is not your middle name.
It's not the middle name.
Good to know.
My parents decided they were going to get cute when you do my initials. So
ABC.
Yeah, exactly.
Gotcha.
It's better than one of those frilly names. So you got that. Then you can go to the NMLS website, which is a nationwide mortgage licensing system, and look up my NMLS number, which is 267844. That's where you can look and see where I'm licensed at, and be able to see if there's been any complaints. And last I checked, there hasn't. And that kind of at least shows that we are set up right within the restrictions that we have within the lending world. And then you can just drop an email to me, which is aaron.chapman@snmc.com.
SNMC.
Sierra November Mike Charlie, as in Security National Mortgage Company. So for right now, that's the best ways to get a hold of me. But I'd always go to the website. You can even look me up on LinkedIn, Aaron B. Chapman. If you see and you have to have the B there too. If you see a helicopter and a person hanging from it, you're on the right person's site.
Perfect. Thanks, Aaron.
It was my pleasure, man. Thank you for inviting me.
Absolutely. I appreciate you doing it. And guys, listen, if you enjoyed what you listened to, if you like what you're hearing from our podcast, please go rate us and review us. Subscribe to the podcast. We're going to keep doing this as long as you guys want us to keep doing it. So we appreciate you guys, and we're going to see you next time. That's a wrap.
Very cool.